Or bring in Mish Schneider, Director of Trading Education and Research for Market Gauge. Mish, good morning. Nice to see you.
Nice to see you, John.
What's your interpretation of the mood of the markets right now?
Well, I think you really just spelled it out well in that there's obviously some optimism around in terms of the inflation numbers. Earnings are mixed and definitely company specific. Intel versus Tesla, for example. Although we can't compare the different companies, there is relatedness with chips. And tug of war, what you just said, really to me represents trading range, which right now I think the market is guilty of until proven innocent in terms of how much more can it sustain. It hasn't really cleared, say, the December highs in the S&P, and some of the other sectors remain still relatively weak, sectors that we think even represent the economy more, like possibly transportation or regional banks. These are the areas still have an eye on to see if they actually show the enthusiasm that traders right now are thinking, because Fed is going to be softer.
And I think, you know, the thing about earnings season is it does give us a sense of not only getting that mood of where companies see the economy headed, but how they're performing versus their peers. You alluded to that with some of the tech names. I think it's interesting, you know, we mentioned American Express, even though the quarter itself left some feeling like they wanted more. The commitment to an outlook that is somewhat encouraging seems to be well received. Bloomberg was compiling just from the S&P 500. I think we're almost 145 companies deep on earnings stories that have topped expectations. But it does feel like it's a little bit more about the outlook for a lot of companies, you know, assuming you don't have a disastrous quarter, versus whether you topped expectations for the actual quarter itself.
Absolutely, and there's been so much rhetoric about guidance too, and it can be very confusing right now if you're trying to be a numbers cruncher and trade off of the economic statistics, some of which are looking back, and of course whatever they say about going forward could be conjecture. So like, for example, just let's take the fact that so many companies have laid off, but then you hear other companies are actually hiring. So I think this is really an important time right now to keep your eye on a couple of balls here. This is what we're doing. Number one is the dollar. The dollar right now is still relatively weak, certainly compared to where it was at its peak. And any particular bounce that people are expecting, this recovery for the dollar to start rising again, hasn't really happened. So I think that has some inherent issues there in the underlying scenario. Number two is I think you have to watch what the Fed's doing vis-a-vis right now through the bond market. So obviously the long bond yields, they have certainly softened from its peak, but they're certainly not doing very much more at this point. And these inflation numbers, they're interesting because we did have a real drop in energy and gas prices, but gas has gone up over the last couple of weeks, about 8%. Oil market is doing better. And I think the precious metals right here, particularly gold, is also saying they're not necessarily gold traders and people, countries like China that are buying a lot of gold, they're not necessarily buying this. Everything is cool. Let's jump back in the water. And, you know, we're just going to have an unbelievable bullish year. And so we're watching that trading range. We're watching that SPY very carefully. 410, December high. We're not there yet.
So that's the technical read. And I guess as we roll through into next week, you know, a lot of people are now looking to what the U.S. Federal Reserve will do on rates. I think on some levels, the tone going forward matters as much as whatever decision they make specifically this time on rates, because we had that storyline play out, as you know, here in Canada this week, where, yes, rates went up again, but the fact that the Bank of Canada said, well, it is time for a pause, was a meaningful decision at a time when you've had just constant hawkish rhetoric from so many central banks.
And it seems like the consensus here is to mirror what Canada just did, 0.25% with a pause. So we'll see. You know, we know that Powell's been much more hawkish, and I know that the PCE numbers are encouraging because they're down from the peak of 7%. But 5% to me is not 2%. And just in terms of just how things move, nothing goes up in a straight line. So this could be nothing more than a correction. And that's because we still have so many unknown factors. We still have the Russia-Ukraine situation. We still have issues with China right now and somewhat of a trade war going on, particularly with the chip industry. We still have issues going on with some social unrest in other countries. We see sugar prices rising. Remember, you and I have talked about that in the past. And we also still see a lot of social unrest even in this country and a lot of division with a lot of sovereign spending everywhere. Japan, 41-year high inflation. And Australia just reached record inflation. So let's not get too ahead, put the cart before the horse here in terms of everything is great. I think you really do have to have some technical basis here of the trading decisions going forward. If you're already in from October lows, December lows, great. My recommendation would be to tighten stops or be looking to take some profits and just give it a little bit of time here to digest, particularly as the Fed starts to come back, and watch that bond market.